Hey everyone, and welcome to the Creative Financing Podcast. I'm Nicole Kamanjian. I'm here with Cody Richard and the host of this show, Jeff Rappaport. This is episode 212, and today we're going to do part 4 of hybrid interest rates. While listening to this episode, if you guys have questions, please head over to our Facebook group, the Creative Financing Podcast. If you're not part of the community already, just search the Creative Financing Podcast in Facebook and ask to join. We will be having a live session once a month on the second Thursday, where Jeff will be teaching different aspects of real estate investing, not just creative financing. If you are watching this on YouTube and have questions, just feel free to ask those in the comments below. If you're getting any value from this episode, please like, share, and subscribe. It lets us know that you're enjoying the content and learning from it, and it motivates us to continue to create these episodes for you guys. We also want your feedback, so please rate and review us wherever you listen.
All right, let's jump in. This will be our last example using the hybrid interest rate, and we're going to use a commercial example. I got this idea. I live in Utah, and the prices here have gone up significantly. Would you agree, Cody? You also live in Utah.
Yes, it's been a wild past few years.
So
Kind of like the gas prices these days.
Exactly. Commercial properties in particular, rentals, bigger type multifamily, trade here at a cap rate of 3 to 4%. And what that means is that if you were to pay cash for these properties, you should expect a 3 to 4% return on your money. And prices are high, so you'd be spending more than likely millions of dollars to get a 3% return on your money. So I thought, we look in all kinds of different markets, and a lot of the markets in the West, right? Colorado, Oregon, Washington, of course, California, are all really high priced right now. And when you're looking at commercial properties, that you are trying to get a better return on your investment than a 3%. But it dawned on me that people do buy properties in these markets, even though the cash flow is really poor, they've got to put down so much down payment that to even break even, that people still want to own properties even in hot markets because they think that they're going to continue to appreciate. So I thought this would be a good example. This is not what I would suggest you go out and use this for. This is still kind of an experiment on my part, but I thought, hey, we could actually go and structure deals on properties that sellers are asking top dollar for in markets that are super crazy. Okay, so this property was in LA, Los Angeles, and they were asking, it's like 10 units, and this is what you need to know about the property. It brought in about $20,000 a month. Okay. So Nicole, I want you to think about the 1% rule here. Okay. Bringing in about $20,000 a month. You might be able to get it to 23. Okay. So it's not a huge, you're not raising rents by a huge amount. Okay. They are asking $4.2 million for the property. So what's the 1% rule of 4.2, Nicole?
Would it be 42,000?
It would be. So if we're at 20,
that's like half.
Yeah, that's like we're at like the half or less percent rule, right?
Right.
And when you get into that range, I never like to go strictly off the 1% rule, but it makes sense. The higher the ratio is between rents to purchase price, the bigger potential for cash flow. So if we get to the 1% rule, there's a good chance for cash flow. If we get to 1.5 to 2% rule, now there's even better chance of cash flow. Where it really makes sense is the further away you get, right? So if you're at that 0.5% or even less, it is really difficult to create cash flow based on the price. Now this is what I like to do, right? Now, this is how we know if it's just ridiculously overpriced or not. So I figured, let's just take 4 million. So we're already discounting this property by 200 grand, right? And let's say that we'll put down 25%. So 1 million, and we will finance 3 million. And let's say that we can get a good interest rate. And when I say good, how about 3.75? Now, let's say that we can even get this based on a 30-year amortization, which may or may not be true. When you start getting into these bigger deals, a lot of times the banks will amortize it over 20 years, 25 years. So the payment goes up significantly. But we're looking at best case scenario here, right? Like good interest rate, longest term. We're trying to give this property all the benefits of the doubt. Okay. So if we do it at 3.75 and amortize it over 30 years, our payment would be $13,893. That's principal and interest. That does not include taxes, insurance, property management, maintenance, repairs, everything else. And let's just, for the sake of, we mapped all that out last episode. Just take my word for it that the expenses are at least $7,000, okay, a month. So where does that put us? At the current rate of $20,000 a month, we're still upside down, right? There's zero cash flow. You have a payment of almost 14,000. You've got expenses of 7. You're paying out almost 21,000. You're only bringing in 20.
You're in negative at this point.
But you have had the privilege of putting down $1 million to get a negative 1,000 or so dollars every month. Who really wants to do that?
Yeah, I don't think anyone does.
Nah, it's hard to really understand why anyone would do that. So what are our choices here? Well, if you're looking at this from a conventional route, so you either do one of two things, let's say one of three things. One being walk away because numbers don't make much sense. Two would be lower the price, right? So let's do that. Okay, let's say instead of 4.2 that we get it down to 3.6. Okay, significant, right? So 3,600,000. And again, let's say that we're going to put down 25%. So we are going to finance 2.7 million. Nicole, do you really think that we can get 3.75% right now on a non-owner occupied 25% down? I mean, we might.
Maybe. I'm not sure how commercial loans actually work, but
typically more.
Yeah.
This might fall into the Fannie Freddie Mac, which might be a little less, but let's just take 3.75 again. Okay, interest rate, and again a 30-year amortization. Our payment would be $12,504. How much have we discounted this property now?
600,000.
Yeah, at some point, does it become not very likely? Maybe at this point, right?
Mhm.
But what are we making? Nothing. This is about break even, right? We're at around 19.5. It's, if we're making $500 a month, yeah, we're not really making any money.
And you're still putting close to $1 million down. So
We're putting $900,000 down.
yeah.
Okay. So I'm curious, and this is what made me start thinking is who's going to buy this property, right? What kind of buyer? Because these properties eventually sell, right? Either the seller keeps lowering their price or someone comes with enough money to make it make sense. But yeah, people still are buying in this market. This is Los Angeles, right? So I started to think, how could I make this deal better for buyers, right? I'm not interested in buying this. I mean, even with creative finance, no thanks. I like cash flow. So, but I started to think, what is a way that maybe we can position ourselves to make this deal better for the people that would look in LA? Well, the first thing that I thought of is, how about give someone some cash flow without having to put down 30, 35%, right? So this is what we offered this lady. 3.7. So it is still a discount, right? Because got to find a way to get that price down. And but could we have offered a little more? Yes, but this was going to be something that we were going to wholesale. So we got to still add in our fee. And I did this with the idea that there would be a 6-figure payday in it. Okay, so so we offered 3.7. Okay, now the down payment. Okay, so we've been talking 900,000 to $1 million, right? I thought we got to get in for less money because we got to create a cash on cash return. Doesn't have to be huge in this case because it's not going to be, but it's got to at least have something to it. So we offered $500,000 with the idea too that, hey, we're going to add at least 100 grand to this, right? To the purchase price and to the down payment. So now, how do we make this work? Well, whenever I have to think about how do I make the payment work, I always go back to one of two things. Does this have to be principal only? Or can I offer some kind of hybrid interest rate, right? So just really quick, the numbers change, as they get bigger. And so if we were, in this case, we're financing 3.2 million, right? The 3.7 minus the $500,000 down payment. So if we take 3,200,000 and we times it by 0.025 equals 80,000 divided by 12. Nicole, that comes out to be $6,666. What is that?
I don't know.
It would be the
Kind of the
interest
double.
portion.
The simple interest, is that what
Yep.
that is?
Uh-huh.
Okay.
It would be the interest portion of the payment. Where have all the payments been? 12,500, 14,000 in that range, right? So we've got to come up with a payment that makes sense payment wise and gets us some principal pay down. Okay, so at 2.5%, it's still $6,600 of a monthly payment. We probably got to get that even lower. So what if we took 3.2 million at 2% times 0.02 is 64,000 divided by 12, 53. So we can knock $1,300 off the interest portion and we'll take it. So what we're going to do is we're going to structure this as 2% interest. And then what's a payment that, you know, is still big enough where we can take advantage of some principal pay down, but still create some cash flow? You know, it looked like we're probably going to be, you know, if 7,000 ish is going to be the expenses, and we're expecting to, we know we got $20,000 in income, but we're thinking it could be 23. So if we, let's say, structured a $9,500 a month payment, that would leave us some cash flow potentially. Not a tremendous amount, right? But either is our down payment. Our down payment's not a huge amount. So let's take this and see where it takes us. 3,200,000 present value, 2% interest for 4 years, 48 months. And let's do a payment of $9,500 negative. And our future value becomes 2.99. Okay, so it's not a huge amount of principal pay down, but in 4 years, someone's got some cash flow, all right? Might not be a tremendous amount, but they've got some cash flow. They didn't have to put down what we're saving them, probably a minimum of 300 to 400 to maybe even $1 million to get to any kind of positive cash flow, right? On the down payment. They're gaining some equity, some principal pay down. It's not a lot. 3.2 to basically 3,200,000 over 4 years, still $50,000 a year. Maybe we need to extend it an additional year. So 3.2 million present value, 2% for 60 months at 9,500 negative. The future value is 2.937. So we gained about another $63,000 or so. So if we're at 4.2 and for 600,000, we can get to 2.93. It's a very good chance that that would be 80%, right? I don't know where interest rates are going to be in 5 years, and my guess would be higher than where they are now. Who knows where these rents would be, but what about the upside? What about that maybe we could add another $2,000-3,000 a month to the rents? And so now all of a sudden, if there's, let's say, so there was 9,500 plus, let's call it 7,500 in expenses. So 17,000, there's only $3,000 a month cash flow, but we can add 3,000. So we're making $72,000 now. 3,000 that we created plus another 3,000 that we can increase, right? So now we're making $72,000 a year. And we were able to put down 600,000. So Cody, what's that cash on cash return?
About 10%.
72,000 divided by 600,000.
Yeah, I can pull it up. 72, right, 600, 12%.
That's solid.
Yeah.
And to be in one of the more expensive
Markets.
areas where cap rates are extremely low, prices are extremely high. All of a sudden this deal doesn't look so unattractive. It actually probably would make a lot of sense. All because we can structure the payment in a way that we need it to be structured. So just looking at, so what does this get the seller, right? Because they had to discount, they have to take less a month, and what does it mean to them? Well, 9,500 times, let's say 60, it's 570,000. They're going to get 2.93 balloon plus 500,000, right? So they're going to net $4 million, which is right what they were hoping for. And by the way, someone that's selling this, this owner has owned this property long term. Do you think they bought it for $4 million?
No.
I know they didn't. So they're going to have a big tax consequence. So one of the selling points, of course, is rather than getting cashed out, paying all your taxes, or doing a 1031 exchange, which she was not doing, this is the best way to go for you, because you'll keep more, you will get more money and only pay out the money that is, you're only being taxed on the money you're receiving. So it's being spread out over time. That way you can still use that money to potentially offset money, right? And for someone to pay cash, that they'd be absolutely crazy to come in. Even at 3.6, it didn't make much sense. It would have to be more like 3.32, somewhere in there. And I don't know that this lady would ever discount $1 million. So we created something that still doesn't excite me to be wanting to buy it, but I bet you there are people that do want to buy it. There's people that like investing in California because prices go way up and they go up quickly. And maybe that's why they're buying it. Hey, by next year, they might be willing to sell it. So, Nicole, after going through 3 different examples, I don't expect that you're an expert on hybrid interest rate, but do you understand it a little better?
Yeah, definitely. I see how you can use get creative basically to make a deal that's not necessarily a deal work through either payment, interest rate, just basically just trying to figure out how the numbers will work to make it to where the seller's winning, but also you're winning too.
So just just for everyone's sake. So remember, I told you we made an offer around 3.7 with 500 down, and to get to that kind of payment, which is by far and away, like, you have to, right? If you can't get that payment, this deal does not work. So you would have to be, so let's see, we're going to finance 3.2 million. Let's say 2% over 30 years. Okay, 2%. over 30 years, we're still at $11,827. This is being amortized, right? At 1.5, we're at 11,000. At 1%, we're at 10,292. I still can't make this work. I'm at 1%. I don't think I can offer this person a 0.7, 0.5% interest, right? I would have to go principal only. That's the only last resort. And I could, but now that's the price is what she's going to net. And when someone's got a big tax consequence, if you can offer them something more, then the story becomes, hey, you can use what you're making to help offset your tax consequence. So just so you understand, there's no way we could have gotten to this payment unless we did principal only. That's why there wasn't huge principal pay down, because there's still a portion going toward interest, and it's eating up. You know, the payment is on such the low side that it's still a good portion of the entire monthly payment. So did that help?
Definitely.
What about you, Cody? I know that you already have an understanding. Did that shed any more light on maybe some ways that you could use this?
Yeah, definitely added a few more use cases of how it could actually be useful rather than, I mean, just a couple that I thought was mainly when, I mean, they just wanted some interest, but not that much, so you could raise the payment to pay it down quicker, or they wanted a short term, but it seems like there's a lot more ways to actually apply it.
I seriously, I try to use it almost, it's probably a 90+% of all the offers that I write has some form of this in it, or somewhere. All right, well, let's wrap this up, and hopefully that was a series that will help people know how, one, what's potentially available to them, and two, to at least give them a little more knowledge on how to use it. And with any part of creative finance, a lot of it's practice. And it's so funny, and both of you are in the academy, and but you two know this. When you follow me doing it, it may make sense.
Yeah.
When you now have to figure it out from scratch, it's like, where do I start? What do I do? How do I do it? Right? It's a little different, and that's why the practice is so important, because now you're able to start seeing things from the beginning and start looking at them in different ways. Yeah, it's pretty easy when you start understanding some concepts to watch me do it, but now I got to throw something at you and say, here you go, where do you go with this? And that's part of the whole academy, is to get people to think in terms of that. And if you want to check something out, send me an email requesting it, or join our Facebook group and request it. I'll send you a free video. That video really points out how to do that, and I think it would be very helpful. And if you're interested in the Creative Financing Academy, let me know. I'm happy to chat with you. It's a great way to start using creative financing as a supplement to your business or a business in itself. If you have interest in our apprentice program, where we are dealing with properties all over the nation virtually, both wholesaling, some rehabbing, even wholetailing, creative finance, you name it, we kind of do it. Commercial, reach out to me or Rebecca at weofferoptions.com. And certainly don't forget, once a month, second Thursday of the month, in our Facebook group, we will do a Facebook Live where we're talking about some topic of real estate investing that I believe that you'll be able to use right away in your business. So any last words, either of you?
Nope.
No.
Thanks, Jeff.
Awesome. All right, we'll go out and create some terms.